Dirty dealings, corporate battles, consumer woes. This is Evening 5. Lotte Chemical Titan Holding is temporarily shutting down one of its plants at the Pasir Gudang complex in Johor effective December 15th to mitigate losses stemming from a prolonged downturn in the petrochemical industry. LC Titan will consider resuming the operation of the plant, named Naphtha Cracker No. 1 plant, when market conditions become more favourable. According to its board's filing, the plant has a nameplate capacity of 430,000 tonnes per annum. With the shutdown of this plant, the company's operating guidance for all its plants in Malaysia and Indonesia for 2024 is between 55% and 60%. This guidance may change from time to time, LC Titan said, adding that it will provide updates on future developments. LC Titan noted the petrochemical industry has been experiencing a prolonged downturn over the past 2 years, resulting in negative margins for the company. The group has been in the red for 10 consecutive quarters. LC Titan's net loss widened to 246.42 million ringgit for the July-September 2024 quarter, compared to 55.58 million ringgit in the corresponding quarter last year. Maritim Resources is aiming to shed its PN17 status by the first quarter of 2025, after having been classified as a financially distressed company for over 2 years. The integrated oil and gas services company had in July this year submitted a plan to regularize its PN17 status to the exchange regulator. The plan includes a share capital reduction of 440 million ringgit, a 10-to-1 share consolidation, an issuance of renounceable rights shares with warrants, and a scheme of arrangement with its creditors. While awaiting approval from the regulator, the company has been actively growing its subsea services business in Malaysia and other countries. Group MD and CEO Dato' Azmi Ahmad told The Edge the company has not yet gone to the international market for subsea business, as its resources and capacity for now only allow it to operate within the country. He said everything will come in place after the restructuring. A group of government backbenchers has called on Bank Negara Malaysia to limit any increase in insurance premiums to less than 10%, ahead of the interim measures that will be announced next week. In a joint statement today, the lawmakers justified the proposed cap, noting that not all individuals who take out insurance will file claims, and that it aligns with regional medical inflation trends. The backbenchers include Bayan Baru MP Sim Se Sin, Tebrau MP Jimmy Pawise, Segamat MP R. Yunis Warren, Miri MP Chew Chun Mun, and Senator Amir Muhammad Ghazali. They said they're proposing a reasonable increase to ensure that insurance remains affordable for the M40, adding it should not be an exclusive service for the ultra-rich. According to the lawmakers, during a briefing by BNM, they were informed that medical inflation in Malaysia stands at 15%, compared to 11.1% in other Asia-Pacific countries. However, they noted that complaints received indicated insurance premium increases of as much as 78%. Insurers and takaful operators have been reportedly planning premium increases of 40 to 70% starting next year, citing a rise in private medical costs. Macquarie Asset Management has reportedly submitted a bid to buy Axiata Group's telco infrastructure unit in a deal that could value it at about $3.5 billion. That's about 15.6 billion ringgit. Citing sources, a Bloomberg report said Axiata is evaluating the offer for edotco Group and has yet to make a decision. Considerations are ongoing and may not lead to a deal, the report said, adding that edotco may also draw other bids. Axiata owns some 63% of edotco. The report highlighted that Macquarie's bid follows Innovation Network Corp of Japan, or INCJ, reviving the sale of its 21% stake in edotco in October. INCJ needs to unload its holding by the end of March, when its mandate to operate ends. It invested $400 million in edotco 8 years ago. Founded in 2012, edotco manages over 55,000 towers in Asia, including in Malaysia, Indonesia, Pakistan and the Philippines. Malaysia will have to rely on household spending next year, Australia and New Zealand banking group warned, as investments are likely to moderate due to uncertainties around US trade policy, while exports may soften amid global slowdown. It said in a report that economic growth will likely decelerate to 4.5% next year, from an estimated 5.1% in 2024. It flagged higher disposable income could bolster consumption, though the stronger demand may raise prices of goods and services. ANZ said the problem for 2025 is the likelihood of higher tariffs imposed by the incoming Trump administration and tighter rules of origin, which lend uncertainty to fresh investment in export-oriented sectors. Malaysia has unveiled measures for 2025, including raising minimum wage and civil servant salaries ahead of the incoming Trump administration. The US president-elect has promised far more prohibitive trade policies than those implemented during his previous term, even before taking office. In particular, he has threatened tariffs targeted at several countries, including China, Malaysia's biggest trading partner. While Malaysia's trade surplus with the US is lower than that of its neighbours like Thailand and Vietnam, ANZ cautioned it still carries the risk of higher tariffs.